What we're going to talk about today is the topic is the spotting short-term trading opportunities. And what I'm going to try to teach you today is what I do every day. Okay? And this is how I trade. Right? What I'm going to show you is the first things I do when I go in the morning. This is what I do. All right? It's really the methodology of finding support and resistance. I'm looking myself to buy into dips in major advances and sell into resistance and major declines. One of the things that I think is unique about the methodologies we're going to talk about today is not only will it work in trending markets, but it's also going to work pretty well in trading range markets, which is different than most systems or techniques used, which generally will work in one or the other. Generally in trading ranges, what we're going to find is that what we're going to learn today, you will generally be selling in the top third of a range or generally be buying in the bottom third of a range. Once in a while, and this is something that's kind of important, it's not written in the text at all, once in a while if you get a buy signal that we're going to see here that's, say, in the top third of a range, that usually means that range is going to break. Okay, so you're usually going to get an upside break. All right, so that's one interesting point to note of. Okay. We're going to look at several techniques today, and like I said, this is just how I trade. I'm not telling you that it's the best way to trade, and certainly not telling you that it's the only way to trade. There are lots of successful people out there that are doing it completely different than I am. Okay, so what I'm going to show you is how I do it. I have worked on a lot of things in the past that are in both my books that from personal experience I will find this works good on this market and something else works on this market. What we're going to talk about today, I think you can pretty much apply on any market. Okay, so it doesn't really matter what you're trading. If you're sort of a short-term trader, this is good. My personal time frame for trading is about 1 day to 1 week. Okay, so that's the kind of things that we're going to look at today. Okay, the cover page of the manual is fairly ambitious, I think, when you look at it. How to buy here. Now, as I said, we're generally trying to buy support in rallies and resistance in dips. Okay? Now, I think by the time that we're through today, we're going to conclude with this chart, and I think by the time that we're through today, I think almost everyone in this room would say, yeah, I would have bought there. Okay? Seriously. Now, I'll tell you, the other corollary to this is, if you buy here and you sell here, then you should be up here. Okay? I want to learn how to do that. All right? We will talk about some exits later on. Okay? Because exits are very important too, as Larry Williams said in his talk. We'll talk about some of those as well. Okay, the major thrust, sorry if I can just borrow that space. The major thrust of what we're going to look at today, and I'm going to probably say this again and again, you may me saying it, but the major thing what I'm looking for is a confluence of the different techniques we're going to look at. Okay? So we're going to look at 5 different techniques today, and I want to see support coming from 3 or 4 of those at the same area in price. All right? The other thing that we're going to do is some of the techniques that we're going to talk about today we can use on different time frames. I'll use them on daily, weekly, and monthly charts. And what we really want to do is integrate these time frames. So if I've got one technique or I've got good support from this technique and I've got also good weekly support, that makes it a lot more important to me. Okay? So we're trying to have a confluence of indicators and an integration of time frames. Okay? That's really, for me, that's the essence of what I'm trying to do. Okay, and I should say, what we're going to do a little bit here is, if you've got the book out, we're going to skip ahead a little bit. There's the flip and flop. Okay, that's sort of like a little bonus, and we'll get to it if we can at the end. But what I want to do is, the flip and flop is very self-explanatory. What we're going to do is skip ahead to about the 10th page, I guess. Okay, it starts off summary of flip and flop, and then it says identifying high probability support and resistance zones. Okay, so that's really where we're going to start in terms of your manual. Now we're going to look, as I said, at 5 things today. We're going to look at floor trader pivot points. We're going to look at Fibonacci analysis. We're going to look at some Gann analysis. we're going to look at what's now called market geometry, which is just sort of like trend lines. And we're going to look at another derivation of pivot points that I've sort of been playing with, which is pivot point channels. Okay, now, pivot points, some of you may well be familiar with. They've been around. They were in Larry Williams in 1970. They've been around forever. All the guys on the floor know where they are. Okay, I can guarantee you no matter which pitch you're in, the guys on the floor know where these things are. Okay? It's very simple math. The formulas are down there in the book. All right, but each day what we do is take the high plus the low plus the close divided by 3. Okay, that gives us a pivot point for tomorrow. Okay, very, very simple math. All right. What we do then is we get a first projected high and a first projected low. For projected high, we take our pivot point, take the difference between the pivot point and the low, and project it up. Okay. For the low pivot point, we take the difference between the high and the pivot point and project it down. That's going to give us a projected high and low for tomorrow. Okay. Very simple, as I said. It's not complicated math. The stuff's been around forever. But if you've watched any of this stuff, you've probably had the experience of saying, you know what, sometimes those pivot points, the market really trades off them. And sometimes it doesn't at all. So how do I know when to use them? All right? So that's what we're going to try to tackle today, is how to know when this is really a high probability trade and when it's just one that we're just going to leave. Okay? Now, as you can see from the formulas in the manual there, what I've shown here is how to calculate the first projected low and the first projected high. Okay? Very simple math to do the second projected high and the third projected high. Okay? Very simple. I'm not going to go through it. It's if you have any kind of software that has a simple formula builder, this stuff will spit it out for you every day. You won't have to do the calculations yourself. Okay? Now, the other thing we do here is I do this again. We integrate time frames. I do this every day on the daily charts. So I've got my pivot point, and I've got my first, second, and third high pivots, and conversely on the bottom for my low pivots. Okay? Once a week, I do weeklies. So I have my weekly pivot, first, second, third high pivot, so forth, and I do the same thing for the monthly. So I've got my monthly pivot, my first, second, and third high pivot, and so forth on the bottom. Okay? So later we're going to see that we now have all these numbers. We're going to try to integrate them later as part of our confluence of techniques. So we've integrated time frames on the pivot point system. Okay? Now, that's the first sort of section that we're going to cover. Now, is everybody clear on this one? Okay, great. Okay, now probably the most esoteric thing, or maybe not esoteric, but something that most of you may not have seen before is what we're going to cover now, and that's something that I've been doing with pivot point channels. And basically what I do to start the pivot point channel is I take a 7-day moving average of the pivot points. Pivot point that we calculated, high plus low plus close divided by 3, that's your pivot point. I average those for the last 7 or 8 days. There's no magic numbers in moving averages, okay? There's no magic numbers. I just use that because it seemed to fit right in most markets. Okay, so I've got that moving average, fairly straightforward. What I'm going to do then is I take my difference between my high pivot, my first high pivot that we calculated before, and my first low pivot, all right? And then I add that distance to the moving average, okay? And that gives me an upper channel each day. And then I take that first high pivot to first low pivot distance, and I subtract it from the moving average. So I have a channel. I don't expect the market to trade in that channel all the time. In fact, I expect it won't. All right? But it is potential support and resistance, especially when the market's in sort of a trading. What I like about these channels, a couple things. If we have a sort of a straight moving average channel, the traditional theory is that you take your moving average and then you take 3% or whatever above it and 3% below it. All right? And that channel is always fixed. It's always the same distance apart from here to here. All right? Then you've got your other extreme, and I don't mean to say they're not useful at all, because I'm sure that they really are useful, is Bollinger Bands. And Bollinger Bands will be all over the place. Right? You can have a lot of volatility in your bands in terms of, the moving average in the middle will be straight, but the outside bands will be going haywire. Now, what this sort of methodology does is it says, okay, we're going to adjust for some volatility here. You'll notice that when the market's quiet, the bands are a little bit tighter together. And when the market's more volatile, like it was over there, or back over here again, the bands are starting to get further apart. Okay, so it does adjust for volatility, but since there's a moving average in it, it does it much more smoothly. Okay, and I kind of like that. Now, there are several ways to use the bands, and as well as using a 7-day centered or a 7-day moving average, I also have something in there with a 20-day. And we're not going to really get into it today, but I think I've sort of alluded to it in the text there. If you start to get markets that are moving through the top channel or the bottom channel of the band when it's got a 20-day, that market's trending. Okay, and then you've got a whole different set of circumstances, and it's probably going to go for a bit. Okay, so you start to get closes outside of that 20-day band. Okay, and that's probably a whole other topic, but you know, you can look at that. I think it's really worth looking at. Okay, is everybody okay with the pivot point or the pivot point channels? Any questions there? Wow, this is great. Okay. Okay, we're now going to talk about market geometry. You call it whatever you like. It's really just pretty simple trend line stuff. I start off using what I say is the 2-bar method because that's what it is. Basically, every day I'm going to go in and I'm going to calculate if I take the difference between my high and my low and project it down here, where would that price be? That's a mathematical calculation. Yes? Yeah, there are. The question was the other pivot points, and I think I tried to cover that. I said, there are other pivot points, a second and a third, all right? But I'm not going to go through the math. They're fairly, they're in the book. They're fairly straightforward. But it does, I thank you for mentioning that, because one of the things I wanted to tell you in my own trading on the pivot points, generally, I'm going to say if the first high and low pivot, and this isn't written down anywhere, okay, in the text, if the first high and low pivot are sort of like a 10, I guess, I would say I would rank the third high pivot as sort of an 8 in terms of its worth to me, and the pivot point itself and the second high pivot is sort of a 6 in terms of its worth to me. All right? So I would think that for my trading, at least in my own observation, that first high and low pivot are more important than the other two. Okay? One of the things I also like to do on the pivot point is if I've got a pivot on a daily and a pivot on a weekly or a pivot on a monthly and a pivot on a daily, that's a really good base for me to start with my confluence of indicators. Okay? 2 pivots are really good. All right? That's a very good start. So thanks for pointing that out. I appreciate it because it allowed me to go back and cover some things that I should have. Okay, now back to the market geometry here. Again, this is a straight mathematical calculation. What's the difference between yesterday's high, today's low, projected here? The same way, if you've got a simple mathematical formula builder on any software you have, you can plug these formulas in. It'll spit out the numbers for you. Okay? You don't really need to draw the trend lines as such, but it's fairly obvious what we're doing here, high to high, low to low, and low to high and high to low. Okay? So every day I'm going to do that, find out where that number is. Again, what I'm going to do here now is integrate time frames. This is something, the pivot points, I integrate time frames. The pivot point channels, I'm basically dailies. Here again, I'm going to integrate time frames. So I'm going to do this work on the dailies every day. I'm going to do it on the weeklies at the beginning of the week. And I'm going to do it at the monthlies at the beginning of the month. So I'm starting to get an array of potential support and resistance here that I can draw on.
Is that on one of the pages?
Actually, no. This is just sort of a blow-up of probably that one with the 4 charts on it. Okay, I just wanted to make it a little more clear than it is in the text. There's a page in the book that has like 6 charts on it, I believe. Okay, and this is just a blow-up of that because I wanted to make it clear. This is really a straightforward mathematical calculation. Yeah, they're potential support and resistance. Most times they aren't going to mean anything. Most times the things we talk about today, most days aren't going to mean anything. All right. What I'm looking for is we have several things here we see have validity. Okay, but what we often see is they don't have validity often enough to really say this works by itself. Okay, but we can see there's something there. I'm sure we've all had that experience, especially if you've ever looked at the pivot points and so forth. So what we're trying to do is say, okay, let's get a lot of things that have some validity and look for a confluence of those things at some particular price point. All right? So yeah, again, we're going to do these daily, monthly, weekly, and that's a very simple, straight mathematical calculation. And if this is all you're going to do with the market geometry section, that's okay. I'm going to show you a couple other things that I look at, but you know, it's fairly straightforward. Okay, trend lines, you know, the oldest thing in the, oops, upside down, oldest thing in the book. You know, trend lines are often a tough thing because you're watching the market, you know, come up, you know, on this third day, and, you know, it's tested here a couple of times, and you're thinking, well, you know, is it going to break? Do I buy the break? What am I going to do? I never worry about that. If the trend line's down, to me, it's a downtrend line. That's it. Okay, I'm only looking at that as resistance. That is it. I'm not looking to buy breaks of trend lines or sell breaks of trend lines. Okay, if the trend's down, that's resistance. I'm not going to sell it on its own. I'm going to look for some other things to have resistance there as well. Okay, but to me, it takes the ambiguity of whether the trend is up, the trend is down. Am I going to buy a break? Am I going to, you know, try to hit the resistance? No, it's the trend is down, the trend line's down. That's a potential sell point for me. Okay, it needs confirmation from other things, but I'm not interested in buying breaks. Okay, same up here. Okay, I'm really only interested in that one in the far left as a support line. Okay, that's it.